Under GAAP, there are two primary methods of keeping track of inventory: the perpetual method and the periodic method. Any business that keeps real-time information on inventory level and that tracks inventory on an item-by-item basis is using the perpetual method. For example, retail locations that use barcode and point-of-sale scanner are utilizing the perpetual inventory method. There are two main advantages to use perpetual inventory system. First, it allows a business to see exactly how much inventory they have on hand at any given moment, thereby making it easier to know when to order more. Second, it improves the accuracy of the company's financial statement because it allows very accurate record keeping as to the cost of goods sold over a given period. Cost of goods sold will simply be calculated as the sum of the total cost of all of the particular items sold over the period. The primary disadvantage to use perpetual method is the cost of implementation. The periodic method of inventory is a system in which inventory is counted at a regular interval. Using this method, a business will know how much inventory it has at the beginning and end of every period, but you won't know precisely how much inventory is on hand in the middle of an accounting period. A second drawback of this periodic method is that the business won't be able to track inventory on an item-by-item basis, thereby requiring assumption to be made as to which particular item of inventory were sold. When using periodic method, cost of goods sold is calculated using this equation. This equation makes perfect sense when you look at it piece by piece. Beginning inventory plus amount of inventory purchased over the period give you the total amount of inventory that could have been sold. We then assume that if an item isn't in inventory at the end of the period, then it must have been sold. For example, Karina has a business selling books on eBay. An inventory count at the beginning of November shows that she has $800 worth of inventory on hand. Over the month, she purchased another $2,400 worth of books. Her inventory count at the end of November shows that she has $600 of inventory on hand. Using the equation we just talked about, we learned that Karina cost of goods sold for November it's $2,600, calculated like this. Granted, this equation isn't perfect. For instance, it doesn't keep track of the cost of inventory. See, if any stolen item will accidentally get bundled up in the cost of goods sold because they aren't in inventory at the end of the period, and there's no way of knowing which item were stolen as opposed to sold because the inventory isn't being tracked item by item. Of course, the calculation of cost of goods sold is a bit more complex out in the real world. For example, if a business is dealing with changing per unit inventory costs, assumptions have to be made as to which one were sold. For example, Maggie has a business selling t-shirts online. She gets all of her inventory from a single vendor. In the middle of April, the vendor raised its price from $3 per shirt to $3.50 per shirt. If Maggie sells 100 shirts during April and she has no way of knowing which of those shirts were purchased at which price, then should her cost of goods sold be $300 or $350? Or somewhere in between? The answer depends upon the inventory valuation method it's used. The three most used methods are known as first in, first out, last in, first out, and average cost. Under GAAP, a business can use any of those three. Under the first in, first out method of calculating cost of goods sold, we assume that the oldest unit of inventory are always sold first. So in the above example, we'll assume that Maggie sold all of her $3 shirt before selling any of her $3.50 shirt. Under the last in, first out method, the opposite assumption is made. That is, we assume that all of the newest inventory is sold before any older inventory are sold. So in the example we just talked about, we will assume that Maggie sold all of her $3.50 shirt before selling any of her $3 shirt. So let's continue on with the example. At the beginning of April, Maggie's inventory consists of 50 shirts, all of which had been purchased at $3 per shirt. Over the month, she purchased 100 shirts, 60 at $3 per shirt, and 40 at $3.50 per shirt. In total, Maggie's goods available for sale for April consists of 110 shirts at $3 per shirt and 40 shirts at $3.50 per shirt. If Maggie were to use first in, first out method of calculating her her cost of goods sold for the 100 shirts she sold in April, her cost of goods sold would be $300 since she had 110 shirts at the cost of $3. And first in, first out assumes that all of the older units are sold before any newer units are sold. If Maggie were used the last in, first out method of calculating her cost of goods sold for the 100 shirts she sold in April, her cost of goods sold would be $320. Last in, first out assume that all 40 of the newer 350 shirt would have been sold and the other 60 must have been $3 shirts. It's important to know that the two methods results not only in different cost of goods sold for the period, but in different ending inventory balance as well. Under first in, first out, because we assume that all 100 of the sold shirt were the older $3 shirt, it would be assumed that at the end of April, her 50 remaining shirt would be made up of 10 shirts that were purchased at $3 each and 40 that were purchased at $3.50 each. Grant total ending of inventory balance of $170. In contrast, the last in, first out method was assuming that because all of the newer shirt was sold, the remaining shirt must be the older ones, the $3 shirt. As such, Maggie's ending inventory balance under last in, first out is $150. The average cost method is just what it sounds like. It uses the beginning inventory balance and the purchase over the period to determine an average cost per unit. The average cost per unit is then used to determine both the cost of goods sold and the ending inventory balance. Let's go back to that example. Under the average cost method, Maggie's average cost per shirt for April is calculated like this. Her total unit available for sale over the period is 150 shirts. Her total cost of good available for sale is $470. And using an average cost per shirt of $3.13, we can calculate the cost of goods sold in April and the ending inventory. So a simple summary, the perpetual method of inventory involves tracking each individual item of inventory on a minute-to-minute basis. It can be expensive to implement, but improves and simplifies accounting. A periodic method of inventory involves doing an inventory count at the end of each period that mathematically calculate the cost of goods sold. First in, first out is the assumption that the oldest unit of inventory are sold before the newer units, and the last in, first out is the opposite assumption. The newer units of inventory are sold before the older units are sold. The average cost method is a formula for calculating cost of goods sold and ending inventory based upon the average cost per unit of inventory available for sale over a given period.